Fellow traders, we are looking at a very important concept in trading, which is ICT, market maker model. Market maker model is an institutional blueprint of price delivery. It shows how market makers engineer price movements by targeting liquidity, inducing retail traders into bad positions, and then delivering price efficiently to a higher or lower liquidity pool. So understanding market maker model isn't just a trading advantage, it is a trading edge. So it is very important to understand this concept. Understanding ICT market maker model is a very vital tool you will need in order to be profitable in the market. Before going deep into market maker model, we need to understand the concepts of liquidity. We need to understand how market handles liquidity. We need to also have a basic understanding of draw on liquidity. So let's dive into deep explanation of how market maker model works and how you can use it to your own trading advantage. Market maker model is simply how institutional traders deliver price from a sell program into a buy program. As you can see here, the market started from an original consolidation, which is the first phase of market maker model. Then we have price push down, and when price is pushing down, price is actually engineering another liquidity. Like if you have got my past videos on liquidity concepts, inducement and liquidity engineering, price only moves with a clear definition. Market is not random. There is a reason price moves. See that price is hunting liquidity, engineering liquidity, and rebalancing to equilibrium. In this scenario, we have price engineering liquidity on the sell side. As price is moving, it is creating failure swings. Inside these failure swings are liquidity that has been generated. Price moves, creating liquidity zones till it moves to the inside a higher time PD array. The higher time PD array can be your swing high or swing low. It can be your order block. It can be your fair value gap, and many others. So when price moves into a higher time PD array, we can see a smart money reversal. In this area, what we regard this place as a smart money reversal. When we have this smart money reversal and price pulls up above that range, then we can say that the market is now taking all those liquidity. The market will start taking all those liquidity that it has generated. You see market moving to take all those liquidity that it has generated during those moves. That is market maker model. Market maker model will easily help you to understand where the price is actually going to go. First of all, before you use this market maker model in your trading, you should first of all understand your draw on liquidity, which is very, very important. Your draw on liquidity will give you an idea of where the market is actually going to do. Most importantly, you need to understand the order flow of your higher time frame. Trading in the direction of the order flow of the higher time frame will give you a higher probability of winning the trade. So in this example, market comes down engineering liquidity in this range, and when it comes here, it enters into a PD array of a higher time frame here. When it enters into a PD array of a higher time frame here, what we see here is a smart money reversal. We see price go down to sweep this liquidity here and create possibly a smart money divergence. Non-market must move and close beyond the swing high of the sell program. Then you can position yourself to make your entry using your entry criteria. So here we see a low risk entry here, possibly a fair value gap, an inverse fair value gap, your order block, whatever you wish to make your entry. It is very important when making an entry to look for a high displacement in this zone. When you see a high displacement in this zone and price created fair value gap, that will give you a higher probability of winning that trade. So when market returns and mitigate that fair value gap, we have the market move up to be taking all those liquidity that it has created. So if you miss your entry here, you can still have other areas of entry before market takes the final liquidity area. So using Maker model and aligning that with your bias and your draw on liquidity will give you an essential idea of what price is doing and where price is actually going. So let's take a look at different time frame alignments that you can use in order to support your market maker model. So this is your time frame alignment that you can use if you are looking at the monthly area of interest. Then you'll be using the daily charts to spot your market maker model. If you are using weekly, the 4-hour will be good. If you are using daily, you'll be looking at the 1 hour. If you are using the 4-hour, you'll be looking at the 15 minutes. If you are using the 1 hour, the 5 minutes. If you are using the 30 minutes point of interest, you look at the 2 minutes chart. If you are using the 15 minutes point of interest, the 1 minute maker model, you're using the 5 minutes, the 30 seconds. So it is very, very important to understand this time frame alignment, because once you spot that your area of interest on the higher time frame, then you switch to your lower time frame, to then you will see your market maker model play out. So let's take a look at the chart and see how we can spot our market maker model and use that as an advantage in trading. This is a recent price action that's happened in the Euro US dollar. So we are on the 15 minutes chart. As you can see, our order flow is bullish here. One thing you should understand about trading using the market maker model is that, like I said, you must understand your draw on liquidity, which is very, very important. You should also understand your institutional order flow. Trading in the direction of the major trend will give you a high probability trade. So you always look at to trade in the direction of a higher time frame. From there, you can get a higher probability trade than trading against the order flow of the bigger time frame. We have our area of imbalance here, which we are expecting price to run to. Then from here, we'll make our entry. So then let's switch to our lower time frame, which is the 1 minute, to support our market maker model. So our draw on liquidity is this range here, is this high here. We are expecting price to come around this high. So let's look at our lower time frame to see if we can spot an entry using the market maker model. As you can see, this is the lower time frame. This is the 1 minute chart. You can see price coming down from this range. Price coming down from this range, creating liquidity to be run. Price come. As you can see here, price from this range is engineering liquidity to be run. We see a series of failure swings here that serves as a liquidity run. When price comes to this area, we see a smart money reversal here. Then we see price push up to come and take all this liquidity to the upside. So we have liquidity build up in around these areas. We have liquidity build up here. We have liquidity here. We have liquidity here. We have liquidity resting here. We have liquidity here. When price comes, it comes and run all those liquidity here. As you can see, this is our sell program, the sell side of the curve, and this is our buy side of the curve. So market comes and take all this liquidity to the upside. If we are making our entry, probably we have taken our entry from this zone. We have our confidence here. This is a breaker, and we have a very big displacement to the upside. It's a confluence of breaker and fair value gap. So this confluence will give you a best entry position. So this area as well can be your valid entry area. So you enter and you target the buy side.